You wake up, pour a coffee, check your phone, and crypto's up like 5% before you've even had a sip. It feels like magic, right?
Or maybe just chaos.
Yeah, exactly. Chaos. But behind your screen, it's actually a highly structured machine. Welcome to your deep dive.
Glad to be here to break it down.
So our mission today is ripping the lid off that machine. We're looking at sources covering Forex, crypto CFDs, and the hidden referral economy driving it all. When you open one of these apps and click buy, what is really happening?
Well, first off, you aren't dealing with private keys or, on-chain blockchain settlements.
Right.
If you're an active retail trader today, you are very likely using a crypto CFD. That's a contract for difference.
Let's unpack that CFD part.
Yeah.
Because trading a crypto CFD is basically like betting on a horse race.
That's a really good way to look at it.
Right. You profit from the outcome of the race, but you don't have to actually buy the horse, feed it, or clean out the stable.
And because you aren't feeding the horse, you completely bypass the slow, expensive blockchain transfers.
Which is a huge relief.
Exactly. You just use execution software platforms like MT4 or CTrader to instantly bet on the price action. And the exact same mechanism applies to Forex, where you're trading currency pairs like UUSD based on global economic data.
So you're simply speculating on the direction.
Right. But since you don't actually own the underlying asset, the broker essentially fronts you the cash to amplify your bet.
Right. So you put up $10 and they let you trade 1,000.
Exactly. That's leverage. And while it magnifies your gains, it exponentially magnifies your losses, too.
Because they fronted you that money, the broker can and will liquidate your position the second your actual $10 balance is wiped out by a tiny market dip.
Yep, it happens instantly.
Wait, I'm stuck on this leverage piece, though. If this mechanism routinely wipes out retail traders because of those tiny dips, why is it even the industry standard?
That's a fair question.
Isn't it just a trap for beginners? It feels like these platforms are just handing out dynamite.
Well, the intended purpose is actually capital efficiency. Professional trading isn't about finding a magical entry point on a chart.
Right, it's not a crystal ball.
Exactly. It's about strict risk management. Disciplined traders use leverage so they can hold a large position while only risking a tiny fraction of their actual capital, often just like 1% of their equity per trade.
But the problems arise when people don't stick to that 1%.
Oh, for sure. The most expensive mistakes in these fast-moving markets are entirely psychological.
Like overtrading.
Yes, overtrading or operating without a defined chart plan, or the absolute classic.
Manually moving a stop-loss order farther away.
You see it all the time. Just to avoid taking a small controlled hit, you turn a tiny paper cut into a fatal wound because you just can't admit the setup was wrong.
So if traders are constantly fighting their own psychology and blowing up accounts with leverage, who is actually winning? Who benefits from all this activity?
The real consistent money isn't in making the trades. No, it's in sourcing the traders. And this brings us to the introducing broker, or the IB model.
Okay, break that down for us.
Well, instead of acting like bounty hunters getting a one-time affiliate payout for a new sign-up, IBs earn recurring rebate-based commissions from brokers like Monaxa.
Meaning they get a cut of their referrals' ongoing trading volume.
Exactly. It's based on volume.
Wait, so the IB is like a casino promoter. They get a piece of every hand you play at the table, regardless of whether you actually win or lose the hand itself.
Basically, yes. They just need you to keep playing. But the math dictates a very specific strategy for smart IBs.
How so?
Because a trader who maxes out their leverage and blows their entire account in a week generates significantly less commission than a disciplined trader who paces themselves.
Oh, right. The one who manages that 1% risk and stays active for 6 months.
Exactly. So the most profitable strategy for the IB is actually long-term trader education.
They actually want you to survive. They want you to use stop losses and stick to a plan because your longevity in the market dictates their longevity in revenue.
Spot on. The ecosystem is built to reward endurance. The longer you stay at the table, the more the underlying architecture hums along.
That is fascinating.
Yeah.
So we've moved from those chaotic morning price jumps to the actual mechanics of CFDs and Forex, where you're betting on the race without owning the horse.
Right.
We've seen how leverage operates as a psychological magnifying glass, and we've peeled back the curtain on this lucrative IB referral economy operating behind the scenes.
I mean, it completely reframes the motivations driving the entire trading ecosystem, doesn't it?
It really does. And I want to leave you, the listener, with a thought to mull over as you watch those charts today. We know the most stable, recurring income belongs to the people referring the traders, right?
Relying on volume rather than predicting market direction.
Exactly. So if the house and the promoters are structurally insulated from market volatility, you have to ask yourself, when you click buy, are you actually participating in a financial market? Or are you just providing the liquidity for someone else's business model?